What a year it's been. And really, in many ways, a really amazing year for markets, to some degree for mayhem. There was some mayhem out there, both in the broader economy, in parts of the market. But, we're looking at 2025 as a year where perhaps we can make volatility great again. So that is another area where I do have my focus. I am looking at next year where I think that we could see a broader dynamic. And remember, volatility isn't just inherently negative. It means bigger trading ranges. It means a more dynamic market. It means more opportunities to trade those ranges. So when I say make volatility great again, I'm really talking about making it more of a trader's market, particularly in the equities. So just to be clear, it's not a call for overt bearishness. It's more of a call for let's look for a broader dynamic in terms of the price ranges that we may experience in this market. So let's really quickly get through the risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. And a little bit about me. I've been trading now for just about 20 years. So it has been quite a journey. I'm dating myself there, but it's actually been amazing. I mean, I was fortunate enough to be able to start my journey with a fair amount of mentorship that was very helpful. And so since then, I've been wanting to pay that forward, help other people learn. That's really the purpose of my presence on social media. It's why I founded Traderade. It's why I'm really interested in trying to share information, because having started this journey with the opportunity to learn from some great minds, I felt it would be helpful to other people that are early in their journey or just continuing to learn, which is something I strongly believe we should always endeavor to do, just to pay that forward. So that's really my whole reason for doing what I do. And I learned a lot over the last 20 years of navigating markets, what to pay attention to, what I try to avoid paying attention to, and also evolving from being a discretionary trader, one who's more driven by gut feel and emotion, to a systematic trader, where I weigh a variety of variables to determine what kind of market environment I think I'm in and how I might be able to best leverage that to make some money. So my approach has evolved from being more discretionary and just more technical to more systematic and more multifaceted over time. And I've been at the helm of Traderade since 2022. That's when we founded the company. And I also co-founded MacroVisor in 2023. And this is all part of that mission to help people learn more about markets. So let's talk a little bit about markets. This is going to be a pretty brief episode. If you're not able to catch the whole thing, no worries. It will be recorded and posted live on our website and our YouTube and X feed elsewhere as well. So it's going to be out there if you want to watch it again as well. Here quickly, we have the year in review. And this is obviously not 100% final. Things may machinate a little bit along the periphery here, but where we are right now is a year that was very strong for tech, not so great for healthcare. Some of the materials didn't fare so well. Some of the real estate and energy stocks and consumer defensives didn't fare so well. But lots and lots of green in tech, lots of green in financials, and in some of the big box stores, Walmart, Costco surging this year as well. And we can't forget NVIDIA up 172.69%. Pretty incredible run it's had. So really, year to date, the S&P 500 up about 25%. It's not often that you have 2 years in a row where each year is up in excess of 20%. The last time that happened, I believe we have to go back to the 1990s. But if we look underneath the hood right now, where we are in the market, things are a little bit dicey. The number of stocks above their 20-day moving average on the New York Stock Exchange is just above 21%. That is bouncing from an oversold condition. And we can see that happen just a little bit earlier in the month. We had a bounce from those lows. That was that Fed Nest Day sell-off that we had when the Fed basically said, hey, we're not going to ease as much as you guys are pricing in. So maybe you want to change your pricing a little bit. And we saw some of that on what was one of the worst Fed days in years. So I think that now the market's kind of digested the initial blow that the Fed's not going to necessarily be there. It changes some of the news dynamics to now we're back in bad news is good news mode, and good news is bad news, because the market is now once again wanting more cuts. It's much less certain about those cuts. So it's out there hat in hand, asking for some more liquidity, asking for the cost of capital to come down, which we can't blame it for. One of the reasons that the rally was as powerful as it was in 2024 and 2023 was in no small part because of easing financial conditions. The fiscal side really overpowered the Fed, and all of that spending by the federal government, the highest deficit spend with unemployment that low as a percentage of GDP ever, really helped to buoy the overall liquidity dynamics, particularly in U.S. markets that were the envy of the world. But now we're on the other side of that, because now there's the passing off of the baton from the fiscal side, from a government that's now dealing with deficit spend on just the interest of its debt that now exceeds the DoD budget. So their ability to spend is a bit constrained unless rates come down. And the Fed is saying, you know what, rates aren't going to necessarily come down that much. But also you see the long end, and it has its own idea as to where rates should be. And that's why we've been in this sort of bear steepener dynamic. And we'll get into that a little bit later. But that's one reason we've seen a bit of pressure. And this is a time where breadth has been pretty weak. In fact, the breadth we're seeing now is some of the worst we've seen all year long when we're just looking at a ratio chart of the S&P equal weight versus the broader S&P 500. But if we look at the number of, or the percentage of S&P 500 stocks outperforming the broader S&P, and the number would show the same chart in essence, just with a different set of labels. But nevertheless, it's on pace to hit an all-time low in December. So this is really, really poor breadth. Now, I know we've been making, some degree of observation about breadth for a while, and there's a reason for that. Breadth in and of itself being low is not a bearish sign. It's not a bullish sign either. It's just sort of one footnote for how you measure risk. Because if you have a very small handful of market leaders and they keep going up, that's great. The market can run on narrow breadth. But if there's any bigger risk off situation, let's say the earnings and revenue growth story for those Magnificent Seven begins to be undermined, then the opposite dynamic can happen. And it looks more like 2022, where you have this handful of stocks really leading the market lower. So that's why low breadth is more of a sign of, okay, we really need to focus our attention narrowly on where these moves are happening, because both sides of the ledger experience a bit of a tail fattening dynamic. But in particular, in a risk off scenario, that narrow breadth can be concerning, because all it takes is, 7 stocks falling, and you've got 40% of the NASDAQ market cap and something like 34% of the S&P market cap getting pulled down because of that weighting of those very large companies. Another thing we're seeing is the New York Stock Exchange new highs versus new lows. Today, new highs are in excess of new lows, which is good to see. But you can see that patch of new lows and excess of new highs over the course of much of mid-December on. That was some of the weakest we've seen in the New York Stock Exchange this year. So we are underneath the surface just seeing some degree of deterioration in momentum, but also this is one of those other measures of breadth. There's not as many stocks making new highs. In fact, there's many more stocks making new lows in excess of new highs from the back half of December up until today. Right? So that's essentially 2 weeks of that kind of underneath the surface rot happening, even in some powerful up days. We've seen that same dynamic. So that's just another concern to consider as we get into the first trading week of 2025 later this week. Now, the S&P 500 does not look very good. Momentum is rolling over, as you can see on the MACD histogram on the bottom. You also see the cash index trading below the 50-day moving average and rejected by it the prior trading day yesterday, right at the 50, to see continuation lower into today. So far, today is trading as an inside day. So it's not overtly bearish yet as of the moment of capturing this chart, but I would be concerned that we have room for continuation lower, and we'll get into that in just a moment. The other chart that I wanted to show for the indices is the Russell. Before we get to the NASDAQ, small caps have just had a violent reversal in December. November was no doubt a great month for small caps. The Trump victory led to a lot of animal spirits. We saw that breakout tested. We went back to the highs, made a new high that was pretty weak. You could see it even reversed on the day. And then from there, the path of least resistance in the small caps has been somewhat violently lower. So we can see that reversal while momentum is starting to become more neutral. Overall, that move in the small caps is something to be concerned about, because that's another area where you're seeing that deterioration or more components of the market not really moving higher when the broader indices had been. The NASDAQ looks a bit better than the S&P and the Russell, which is to be expected because NASDAQ stocks have really been the leadership stocks in 2024. But it is still below its 21-day exponential moving average and just hanging above that 50-day. So if it does close below that 50-day, I will become much more concerned about broader weakness being possible, particularly for those larger techs. Now let's look at some of those more popular parts of the market. The semiconductors is one. There's been a lot of folks looking for a major reversal here after so much consolidation. And of yet, we haven't had it. What we've had, however, are a number of head fakes, both up and down in SMH, with these moves taking us above and below the 21 EMA and the 50 SMA. Right now, we're trading below both with some degree of neutral momentum, just this coiled spring over the last 2 months. This is something to pay attention to, because whichever way SMH ultimately does move, it's likely to be a pretty big move. So I do like the look of this chart from the perspective of when the consolidation that's been going on for months finally breaks one way or the other, it's likely to be a pretty sizable move, and that can be a great momentum trade. So we'll continue to watch SMH. I would be inclined to think it tries to move higher and catch up with some of the leadership in the space, but we'll see what the market brings us. NVIDIA also looking a little bit precarious here. It did have a nice push off those lows, tested breaking above that, the 20 and the 50, broke above the 20 for a bit, couldn't hang above the 50 for very long. NVIDIA's chart's losing its positive momentum. It still looks like it's putting in a lower high recently, and it has this sort of look of lower highs, lower lows, reversing that positive momentum from earlier in the year. And it sort of had this in and out. Over summer, it lost its momentum, then it got it back from September into November. Now it's lost it again. So it's hard to tell exactly where this one's going to go. I imagine it'll set the tone for SMH as well. But I'm inclined to think that NVIDIA has some hardship ahead in 2025 from the perspective of regulators. I think the EU and possibly China will crack down. The EU could pretty much tell NVIDIA have to let competition into CUDA. You've seen similar orders from the EU to Microsoft, to Google, to Meta, to Apple, and others. It wouldn't be too surprising for them to do the same for NVIDIA, and that would cause them to lose some of that competitive edge. They would have to take a hit on margin to become more competitive with other hardware vendors in the space, and typically semiconductors are not high margin. So, the NVIDIA AI GPUs had been selling in mid 80% margins. Now they're down to low to mid 70% margins. If such a ruling came through, it'd probably bring them down to 30-40% on those margins, if not lower. And that would also erode their data center market share. So that's the kind of the big risk. It doesn't mean it's going to happen. But I do think that for all the risks that we have to factor for NVIDIA, the regulatory risks are big, as are economic risks if companies stop spending so much on AI. And there's no sign, by the way, anytime soon that that's going to happen. There's still lots of very aggressive spending plans. But if they were starting to signal that, and let's say the economy turned lower and that's why, that would be another risk to take into consideration. But I personally think the regulatory risk is more realistic. And if we do want AI to move forward, if we are bullish of AI as a theme, and not just bullish of NVIDIA as a company, then we don't really want a monopoly on GPUs. We actually want competition. We want lower buy-in costs. We want the ability for startups to be able to buy compute with less capital, to be able to buy more compute, to be able to train and infer models and otherwise work with these GPUs at a much lower cost. The only way that happens is if the space is made to be more competitive, and the easiest on-ramp is to make CUDA multi-hardware platform. So we'll see. Another popular stock, Palantir, pulling back just a little bit here, down about 0.5% as of the making of this chart. Momentum starting to turn a bit negative. This is one where I'd be watching the 21 EMA. I think that's a pretty good momentum indicator for the way the shares trade just in the near term. So for now, still kind of consolidating here its latest new all-time high move that it made just last week. I'm not particularly concerned about Palantir from a technical perspective or from an options perspective. I'm concerned about it from a fundamentals perspective because we aren't terribly far away from their next earnings. And I do think that they have a lot to prove to shareholders, myself one of them. It's a position I've had, and it's been over a 10 bagger now. It's a great investment, but I do think it's frothy here. I have been selling some covered calls against my Palantir exposure because the vol got pretty expensive. And so selling into those mid 80s was not a terrible idea. I would do it again on strength. As we get up to earnings, I would lay off that strategy, obviously, because I don't have a strong directional call into that. But for now, this is a company with a lot to prove. So it means I wouldn't want to be adding here. For my strategy, I like to sell covered calls instead of realizing gains on shares. I'll just pocket some of that premium. And that's something I'll be doing. And, for those that ask, well, what if you get, what if your calls go into the money and the shares are called out of your portfolio? That's fine. I'm happy to sell put premium to get shares put back in. That's how I would run it. Basically like an options wheel. For some of my longer term investments, I do like to harvest premium to reduce my cost basis. And then that way, not only do I have an advantageous entry price for the stock, but I can continue to reduce my cost basis by selling premium when there are episodes where I feel like it's getting a bit ahead of itself. The next one we have is Bitcoin. And boy, it's looking a bit dicey. Got a death cross today on the 21 versus 50, got a rejection right at that level. And even though overall we're still up, we're well off of our highs. That convergence area of the 21 and the 50 seems to be an area of resistance that so far traders have not been able to overcome. We've basically seen several rejections off of some of these key moving averages, but more than that, we've seen a pattern of lower highs and lower lows in Bitcoin after it made its high at about 108,000. We've also seen one of the largest buyers at the margin, MicroStrategy, buying less and less as they are probably seeing the appetite for their convertible notes and their equity reduced, and their stock price going against them, down over 40% from its highs. Not helpful to this strategy either. So speaking of that stock, we can see MicroStrategy on screen rejecting below the 50 pretty clean last 2 days in a row. Today building on that rejection, and that tells me that there is room for this one to continue to move lower. So I've been pretty bearish on MicroStrategy. I've been pretty openly bearish on MicroStrategy since late November because it looks like this parabolic top that's failed. And now we have the momentum confirmation in multiple ways. Obviously, the MAC histogram flipped in early December, got quite a bit more bearish there. But now we can also see that rejection below the 20, which was important for part of this move, but particularly below the 50, where it's really hard to argue this thing has anything even vaguely resembling positive momentum here. So I think this is one of the stocks that probably has the biggest amount of risk. I understand, some folks are kind of bullish of it because they think this is the infinite money glitch. It's only going to go up forever. I've seen a lot of crazy posts out there on social, and no disrespect intended to anyone out there that's bullish of this thing, but I think it's garbage, and I think it's going to go down by a lot. And I think it's very, very dangerous, the strategy that Michael Saylor is running. His core business has failed. And now he's basically turned his company into a Bitcoin borrowing machine. Now, look, if you're bullish at Bitcoin, fine. Be bullish at Bitcoin. You can express that in other ways. You can go long Bitcoin, directly. You could go long Bitcoin via ETFs, via other kinds of derivatives, if that's what you want. Personally, I think that's risky here for the reasons we discussed in the prior chart. Momentum is not on the side of Bitcoin bulls right now. But why buy MicroStrategy? Why get the exposure to the risk of this company's management? Why get exposure to the risk of the company itself in this crazy strategy, issuing debt to buy Bitcoin and basically buying that Bitcoin at like 2x NAV or whatever it is right now? So you're basically like, when you buy MicroStrategy, you're buying Bitcoin at a break even of like $200,000 a coin or something crazy like that. Why? Just if you really like Bitcoin, and again, I'm cautious here, and this was after I nailed the lows of like 65,000, 66,000, not too long ago. And I said we could get to 100, and we didn't. And then a bit more. I'm cautious as heck here. I think the momentum is now not on the side of Bitcoin or a lot of the other crypto stuff. I think that liquidity dynamics are changing. Interest rate dynamics are changing. And we'll get into that in a minute. And that's something to be concerned about with all this long duration risk, whether it's unprofitable growth or tech, whether it's, crypto, any of this kind of stuff, and particularly the sort of leveraged casino schemes like Michael Saylor's MicroStrategy. I would just be extraordinarily cautious here. I think a lot of this stuff has had a phenomenal run. I think financial conditions are tightening, and sort of that excess liquidity at the margin that was seeking outsized returns is drying up. Now let's get into the S&P 500 options complex here. We can see 5,900 has become a pretty big level. I think that this is important just from the context of we've seen a lot of positions rolling down. Earlier, even this month, we saw large positioning at 6,100, 6,200, lots of upside bullish speculation and calls. Now we've seen a lot of roll down, and now we've seen much more bearish positioning as well. More roll downs with puts as protection. I don't think it's all just downside speculation. The way that other positioning looks, it feels a lot more like folks are getting more concerned about hedging those longs out. So when you hedge those longs out, you're obviously going to be less of a motivated seller if they go against you, because you can kind of cash in on some of that insurance policy with those hedges. But on the other side of it, it is something to be concerned about in the sense that, we've kind of seen a pretty big shift in where that positioning is. And that's also helped to bring us deeper into negative gamma territory. Both the roll down of those positioning and the price change that's happened in the S&P has pulled down the gamma flip level to 59.71. And that puts us about 100 points into negative gamma. So that does mean we're in a market environment where there's likely to be higher levels of realized volatility, and where downside continuation is more likely. When you're in negative gamma, you're more likely to see downside continuation. Just like when you're in positive gamma, you're more likely to see upside continuation. This is also a market environment just really since the great financial crisis where shocks are more common. Certainly not pricing for that. If you look at overall the very complacent levels of volatility across multiple asset classes, the sort of upside that folks are still looking for in markets, there's not a lot of concern about this. And that's also because you can't predict shocks in advance. No one could have predicted, some of these shocks you see on the chart, like COVID coming in advance, like Feb 18, like that Volmageddon event. A lot of those things, there were all these signs that things were going to maybe go off the rails at some point, but there wasn't a clear sense of timing as to exactly when. So you can't hedge for it with options. You can't necessarily stay short for things like this with rates as high as they are on the margin. That margin maintenance cost gets pretty high. So you have to be very tactical, which is why I think we see a lot more just-in-time types of hedging flows. And I think on the other side of it, it also means we do have a bit of a more fragile market dynamic that if there was an event like this to happen, this chart doesn't surprisingly include the August 5th event, but I do think it would deserve an entry on here because it was a significant event, albeit short-lived. It was a shock. And that's the type of thing that I'd be a little more concerned about. Not just like a all out, oh gosh, we're going to, see a never ending bear market. Things are just going to go to zero. Like, I think those types of events are more insular and more exogenous. I don't think that those are going to be things that happen with any degree of reliable frequency, but the kinds of shocks that you can see where it's like a 1 day to 1 week, crazy levels of volatility and repositioning, I think that's become more likely over the last 16 years. And those are the things where if you're running margin, if you're running leverage, you have to be concerned, because one of those events can either make you really, really, really profitable or kill you, or both in a short period of time. So let's go to the big picture real quick. Just got a couple more slides. We're going to wrap this up, and I will post the recording in not too long. The yield curve between 2s and 10s is the steepest it has been in over 2 years. Really have to go back to 2021. So really it's about 3 years now that the yield curve has kind of gone back to normalizing. Now what's interesting about this is it's led by a bear steepener. This is a yield curve steepening that is led by the 10-year, the 20, the 30, the long end of the yield curve is really pulling rates higher. The short end is a little more anchored, although the Fed did help to push that short end higher as well by walking back rate cut expectations really for the last 2 months. So why is this important? Because it has an impact of pulling the dollar higher. It also has an impact of tightening liquidity. And as I've been saying for some time, 4.5% is a line in the sand. Evercore has a similar note out. So it's interesting to see other folks doing research seeing the same connection. So above 4.5%, they call it a headwind. Above 4 3/4, they call deeper and longer correction territory. They're talking about the S&P. And then above 5%, hurricane force winds. And the reality is I would not be particularly surprised to see 4 3/4 to 5% be the average rate on the 10-year next year. So that's why I'm saying volatility could become more of a theme. It could become more of a dynamic that we have to contend with reliably. And that's not a bad thing if you're trading. If you're investing, it does mean you may have to change your strategy a little bit. If you're a longer term trader, it means you may want to be taking smaller size and accounting for those larger risks. And if you're a near term trader, it means you're likely to see larger price runs in those day trades, right? Between the bottoms and tops of price ranges you experience in a single day. Now, the other effect that rising rates on the long end has had is really setting up the dollar for its best year since 2015. Remember how many folks told us the dollar was about to die for the last 2+ years? The dollar's going to die. We're all going to die. It's all going to be replaced by some BRICS currency or a crypto or gold or you name it. There was a conspiracy for every one of these options that was going to happen potentially with the dollar. None of them came true because despite what we might say about the dollar and its diminishing purchasing power for those of us that transact in it, it is still the best of a lot of other bad currencies. Would you prefer the euro? Would you prefer the yen? Would you prefer the Great British Pound, the Canadian loonie, the Aussie? Would you prefer the Chinese yuan? Like, what currency is faring better than the dollar? There's not many out there. And you can't really reliably transact in gold or Bitcoin. You can't really use a basket of currencies to transact in that much. That whole BRICS thing is just not going to happen anytime. The ruble is basically being in free fall for years. So that's not even an option. India's currency, which would be one of the BRICS currencies, it's the I in the BRICS, their currency is not doing well. Neither is the Brazilian real. Theirs not doing well. That'd be the B in BRICS. So you got the B, the R, the I. China's currency is not doing terribly well. That's the C in BRICS. South Africa's currency, that's the S in BRICS, not doing terribly well. So all the BRICS currencies not really doing well. You wouldn't really want a basket of those currencies to be what you transacted. Now, if we could make a basket of currencies that was backed by a stable set of commodities or, some sort of weighting that actually had some reflection on what they were going to be buying so they had more stable purchasing power, that would be interesting. maybe that could be a contender in decades to come. But for now, the dollar is what it is, and it's still used in the vast majority of international transactions, which is important. And it's one of the reasons I've brought up the last two sets of charts, rates and the dollar, because this is bad for emerging markets. What's happening with the dollar and rates are going to make it more expensive for emerging markets to service their debt. There's an enormous amount of dollar-denominated 10-year benchmark rate debt out there. And we're talking about like 100 trillion. A lot of it is in emerging markets. Some of it's in Europe and other parts of Asia. But at the end of the day, rates rising makes that all more expensive to service. That's another reason that global liquidity dries up the more that 10-year presses higher, the more that dollar presses higher. So that's why we look at this other chart from Evercore and say, okay, this is why this could become an issue. Because if you look at the S&P 500, 40% of the income that these companies make comes in from overseas, right? So a stronger dollar also is a headwind there, both for the affordability of those goods and services and the rates of foreign currency conversion that they're going to get into dollars and how well hedged they are. And I'll tell you, a lot of these companies aren't particularly well hedged for this stuff. So that ends up being a headwind. So it's just all things that we should take into consideration going into 2025, a year where we could see a continuation of dollar strength, of rates on the long end staying firm and rising, of liquidity dynamics deteriorating a bit because we don't have a Fed that's going to be quite as excited to come to the rescue. There's nothing really to come to the rescue of. I mean, this was a Fed that caught 100 basis points into all-time highs in crypto, gold, stock market prices, housing prices, into an economy where unemployment is low. It's near generational lows, where the labor market's bottom hasn't fallen out, where the economy is still moving forward, albeit a K-shaped distribution. It's still moving forward in the aggregates. There's nothing that really said the Fed had a lot of room to cut, but there was an area where it became a little bit more exigent, and that is that the cost of servicing the U.S. debt has just continued to spiral out of control, over $1 trillion per year. So if the Fed had any reason to cut rates, it was probably the last thing that they wanted to do, because it makes it more obvious that to one degree or another, the Fed monetizes the U.S. government's debt. In this case, it just gives them a haircut on the cost of it. But, direct monetization can still happen again, and it probably will. But for now, if the Fed is being handed the fiscal baton, and now it's becoming the monetary baton, and they're saying, we're going to slow down the pace of our race. We're going to put our foot on the brakes a bit here, while the fiscal side's already putting their foot on the brakes. That's a de facto tightening of financial conditions from where they were at their base. That's why it's important to kind of look at this stuff going into next year and say, okay, unless we see a big stimulus from China, or unless the Trump administration does some big fiscal spend, which is going to be harder given the cost of servicing this debt, or unless the Fed really cuts more aggressively, we're still in an environment where financial conditions could be tighter than prior years, and that could have an impact on earnings, economic outcomes, and the performance of risk assets. So that's really the crux of what I wanted to present. I hope this has been helpful to you all. I'm going to cap it here because I want to be mindful. I know it's New Year's Eve. I know everyone's got a lot to do. If you're not already celebrating New Year's, wherever you may be in the world, I hope you have a wonderful New Year's celebration and a wonderful and prosperous year ahead in 2025. So thank you so much for watching Navigating the Markets. The next episode of Navigating the Markets will be coming up Monday, January 6th, and that'll be at 5 p.m. Eastern. Catch you then.